Hey everybody, this is Robschild. Saturday, July 5th, 2025. Today's episode is about the last week. On the surface, the data seemed good and the market seems strong, although I think there's more cracks than most people realize. We'll start today with our first headline. Megacaps carry market to new highs. Breath good but not great. What I mean by this is that the advanced decline line, I don't have that chart here, along with the S&P 500 both going up. Everything's going up. But if you take RSP, an equal weighted index, we are not at all-time highs yet. In the semiconductors, we are kissing all-time highs, basically at a double top, which actually can act as a top. So we could actually potentially have a top in already. And then IWM, the Russell 2000, once again, we are still 9% away from the all-time highs. So although everything's sort of participating in this rally, not everything is as peachy as the S&P 500 is sort of suggesting. We also had a bunch of data come out this week. The economic reports, the ADP numbers came out a lot weaker than expected at negative 33,000, while it was expected a growth of 100,000. The job openings was a pretty high number, but that was the only real actual strong good news I think that came out of this week, because the supposedly strong jobs report comes with a lot of nuance. You're probably aware that the expectation was unemployment to be 4.3%. Instead it was only 4.1%. That had a lot to do with the participation rate being very weak and getting weaker. Less and less people are even bothering to look for jobs right now. Maybe they're feeling rich off of their meme coins, I don't know. And then the rest of the employment report, all of the jobs that were gained, most of them were in government, state and local government specifically, all while federal government is seeing losses. We also had some additions to healthcare jobs, which is a normal positive thing, but the majority of it being local and state governments tells me this report is not something to get too excited about, and the markets seem to know this. And we'll talk about the charts and how they're reacting in a little bit. First, community topics. Happy 4th of July, everybody. I got to see some awesome fireworks. Tell me about any fun things that you did on 4th of July in the comment section below. Coming up, tariff updates. We still have to see what's going on with the tariffs. Remember, when the first tariffs hit, the S&P 500 crashed by 20%. They're coming back, so hold on to your hats. As always, thank you for watching, subscribing, commenting, and supporting. No changes to the daily reminders, macro views. See my website to see these very important daily reminders. This is the situation we are in. This hasn't changed. As much as we like to put on our blinders and believe everything is fine, it's not. Take a look at my website. No changes also in the crystal ball readings nor the Robschild portfolio. Moving on to charts, we're going to start with TNX, the 10-year Treasury note yield, only because we had this head and shoulders top that broke, and although Thursday's supposedly good news, drove longer yields higher, they weren't driven higher enough to cause any disruption in this bearish-looking chart. In fact, we are retesting the neckline of this head and shoulders top, suggesting that there's more downside to come in the 10-year Treasury note yield than there is upside. Add to this the MOVE index, also known as it is the volatility of bonds. Interestingly, while bonds went down in price, the volatility of bonds actually dropped. This mismatch actually tells me that this is saying that bonds are not bearish. People aren't selling bonds hand over fist. In fact, the bond market, in my view, is getting stronger with the MOVE index dropping to new lower lows that we haven't seen since February of 2025. Sorry if the charts are a little out of order today. I gotta do this quick. I recorded the whole thing and my software got messed up the first time I tried it. Anyway, wanted to bring up Bitcoin. There's some pain in Bitcoin. It's not looking so bullish. I was looking at Bitcoin on Thursday, seeing this breakout candle and saying to myself, whoa, are we headed to new higher all-time highs? Well, that's No, we are not. Actually, we didn't get that confirmation candle above. We would have needed to see the next day or in the next few days to stay above this blue line here and confirm, like have a close. In other words, the end of the candle be above the wick of the breakout at 110.535. Instead, we broke right back down, negating this trend line. This hurt a lot of the bulls that were thinking that this would keep going higher. Next, gold. I want to bring up gold because gold's been chopping sideways here for a little bit. I mean, besides the fact it's never been more expensive compared to crude oil or housing or pretty much anything else, including its moving averages. And you know, it doesn't make any sense for me for it to be up here in the first place. But main point here is that gold is not continuing higher. If everything was so peachy in the economy, everything was hot, 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 maybe gold could get a bid, and instead it's sort of petering out here a little bit. I want to bring up junk bond credit spreads back to sub 3% zone, just to remind everybody, you know, within the past 25 years, we never really go below junk bond credit spreads below 3%. The amount of money you have to pay for the amount of money companies that have junk bond credit status, they only have to pay a little bit higher than treasury bond rates. And when it's super low like this, it's super complacent, as we saw, for example. The best example in this whole chart is May of 2007, when everybody thought, no way any company would ever be, you know, have any weakness. Nothing's going bankrupt. Everything's perfectly fine. That was right before the great financial crisis. Is that happening right now? Are we getting into that complacent zone? Yes, I think we are. I wanted to bring up the put to call ratio. It's been dropping as we've been getting to new highs, so less bears. We're killing more bears as it stands. This, for me, it can be a contrarian indicator, suggesting that once all the bears are dead, the markets can then fall. And fear and greed index and CNN business, we are in extreme greed mode. Again, this is like complacency zone for me. Next chart, I want to bring up 10-year break-even inflation rate. You know, with this supposed strong jobs data, you know, maybe the market might be pricing in higher inflation. Not really. I mean, we're sort of consolidating a little bit. We're not spiking to the upside or to the downside right now, but we still, to my eye, are in a pattern of lower lows and lower highs in the 10-year break-even inflation rate, although going sideways more than anything. Last chart of the day, I probably missed some things that I wanted to talk about. This is the second time I had to record it. Sorry about that. I'll try to get things, as you know, I'm not in my regular studio, so hopefully the show will get better over the next week or two. Anyway, the last chart of the day, 10-year minus 3-month. I just want to note that since end of May of 2025, we've been going back towards zero and continuing to invert deeper and deeper, suggesting that yes, the Fed right now is restricting the economy. The Federal Reserve Fed funds rate is currently high enough and is expected to stay high enough to keep this inverted right now. And we've been basically at zero and inverted, suggesting that, you know, this 2.5-year historically long period of inverted rates is sort of just continuing here. This is not this market is saying we are not in an easy money territory. The central bank of the United States is currently still holding the head of the economy under the water, all the while the S&P 500 is reaching, again, new all-time highs. Very worrying. That's going to be all for today's show. I hope you enjoyed. Thank you for watching. See you next time. Robschild.